What if I told you that losing money in the market could actually save you money on taxes? Sounds backwards, right? But every year, smart investors legally use their losses to cut thousands off their tax bill, and most beginners have no idea they're allowed to do this. In the next 12 minutes, I'll break down tax loss harvesting in the simplest way possible. No jargon. No accounting degree required. By the end of this video, you'll know what tax loss harvesting really is, how it works step by step, and when it helps and when it can actually hurt you. Let's get into it. Here's the mistake most beginners make. They look at their portfolio and think, this stock is down, I'll just hold it and wait. And that might work. But what they don't realize is that a loss on paper is useless for taxes. The IRS, or your tax authority, doesn't care about losses you haven't realized. Only realized losses count. And this is where tax loss harvesting comes in. Tax loss harvesting is simple. It means selling an investment at a loss on purpose to reduce your taxes. That loss can then be used to offset gains you made elsewhere or even reduce your taxable income. You're not giving up forever. You're strategically using the loss instead of wasting it. Think of it like this. If you already lost money, why not at least get a tax benefit from it? Let's look at a simple, real-world example. Say this year you made $10,000 in profit selling one stock, but another stock in your portfolio is down $4,000. If you do nothing, you pay taxes on the full $10,000 gain. But if you sell the losing stock, that $4,000 loss offsets your gain. Now you're taxed on $6,000 instead of $10,000. Same portfolio, same market, lower tax bill. That's tax loss harvesting. To really understand this, you need one key concept. Capital gains are profits from selling investments. Capital losses are losses from selling investments. Tax loss harvesting simply uses losses to cancel out gains. And here's the key rule. Gains and losses must be realized in the same tax year. Timing matters. Now, here's a question most beginners ask. What if your losses are more than your gains? In many Tier 1 countries, you can use losses to reduce ordinary income and carry forward unused losses into future years. So a bad investing year today can lower your taxes for years ahead. Losses don't expire immediately. They're like tax credits from your past mistakes. Now listen carefully, because this is where beginners mess up. You cannot sell a stock at a loss and then buy the same or substantially identical stock back immediately. If you do, the tax loss is disallowed. This is known as the wash sale rule. In simple terms, you can't fake a loss while keeping the same investment. Typically, you must wait 30 days before buying it back. This rule exists to stop abuse, and ignoring it can erase the entire tax benefit. Experienced investors don't panic about wash sales. They usually do one of three things. They wait 30 days and then rebuy. They buy a similar but not identical asset. Or they shift temporarily into another sector. For example, they might sell one tech ETF at a loss and buy a different tech-focused ETF. Same exposure. Still legal. Tax benefit intact. So when does tax loss harvesting actually make sense? It works best when you're in a higher tax bracket, when you have realized gains, and when markets are volatile. It's especially powerful in bear markets, sideways markets, or years with large capital gains. It's less useful if you have no gains, you're in a very low tax bracket, or you plan to sell everything soon anyway. Before we wrap up, let's talk about common beginner mistakes. Mistake number 1. Selling just for taxes, not strategy. Mistake number 2. Triggering a wash sale. Mistake number 3. Forgetting long-term goals. Mistake number 4. Letting taxes control emotions. Tax loss harvesting is a tool, not a religion. Never let tax savings ruin a good investment plan. Here's the bottom line. Tax loss harvesting doesn't make you rich, but it keeps you from giving money away unnecessarily. Smart investors don't just focus on returns. They focus on what they keep after taxes. If you're already losing money on an investment, you might as well make the loss work for you. If this helped you understand taxes without a headache, hit like, subscribe, and I'll see you in the next one.